Investing is scary. Investing in stocks? Even worse. But it doesn't have to be that way. With this video, you'll learn the basics of investing and stock trading for beginners. Hey there and welcome to Stock Market Mate. In today's video, we're going to talk about how to invest in stocks, especially if you're a beginner. The last couple of years have been incredibly challenging for investors, but it has also provided some great opportunities to learn about how the stock market works. It can be hard to find your way through those treacherous waters when you're not sure what's happening or when you know nothing about it. With that being said, this video will provide an easy and simple outline in order to help you steer yourself safely through these, let's say, unusual times. Disclaimer: you're not going to be an investing expert in just one video. What it will do is get you on the right track. Without further ado, here are 5 beginner tips on how to invest in stocks. Whether you're a seasoned or amateur investor, pay attention to these tips so you too can maximize your returns. Tip number 5. Know your market cycle. Cycles are prevalent in all aspects of life. They range from the very short term, like the life cycle of a June bug, which lives only a few days, to the life cycle of a planet, which takes billions of years. Markets move in 4 phases. Understanding how each phase works and how to benefit is the difference between success and failure. The problem is that most investors and traders either fail to recognize that markets are cyclical or forget to expect the end of the current market phase. If you want to maximize your returns, you should understand these cycles. Markets move in 4 phases. In the accumulation phase, the market has bottomed, and early adopters and contrarians see an opportunity to jump in and scoop up discounts. In the market phase, the market seems to have leveled out, and the early majority is jumping back in, while the smart money is cashing out. In the distribution phase, sentiments turn mixed to slightly bearish, prices are choppy, sellers prevail, and the end of the rally is near. In the markdown phase, laggards try to sell and salvage what they can, while early adopters look for signs of a bottom so they can get back in. A cycle can last anywhere from a few weeks to a number of years, depending on the market in question and the time horizon at which you look. Smart investors who recognize the different parts of a market cycle are more able to take advantage of them to profit. They are also less likely to get fooled into buying at the worst possible time. Tip number 4. Choose an area that you excel in. If you want to be a step ahead from other investors and get those immensely high returns, then you should invest in areas that you're competent in. Take a moment to ponder and assess what you know. If you're a young man, then you probably know something about gaming, social media, or artificial intelligence-based businesses. With that, you'll have a better idea on what companies or industries will thrive in the future. If you're a bit older, you have the best chances at succeeding in more mature businesses like those centered in hospitality, travel, wine, or food. The list goes on. You can take it from Warren Buffett. He only sticks to businesses that he knows well, and you should be doing the exact same thing. We can fairly apply one of Peter Lynch's well-known quotes, which is incredibly simple yet striking. According to him, know what you own and know why you own it. You see, a lot of investors want to make the biggest returns, so they want to invest in every single industry, but rarely do they stick to the ones that they know by heart. They don't know what they own and why they own it. You can take that as a sign to not be like them. You should avoid purchasing a stock unless you have an extensive knowledge of how the companies make money. What do they manufacture? What kind of service do they offer? In what countries do they operate? Are they known as the leader in their field? Think of this as a first date. You probably wouldn't go on a date with somebody if you had no idea who they were. If you do, you're asking for trouble. Tip number 3. Know how the game works. If you were randomly picked to play poker with a $500 bet and you had zero experience, you probably wouldn't take the risk. I mean, who would? You'd be wasting money if you didn't know how to play. You can take that idea and apply it to the stock market. You'd be surprised to know that a lot of young investors don't actually know the ins and outs of investing, not even the basics. If you're new to the investment game, particularly in a volatile time, there's some critical information that you need to know about. Let's start with the PE ratio. This is an essential metric to know. The price-to-earnings ratio, or PE ratio, is one of the most widely used metrics for investors and analysts to determine stock valuation. This helps investors determine the market value of a stock as compared to the company's earnings. Next, we have the ROE, or return on equity, where ROE is the measure of a company's net income divided by its shareholders' equity. It is a gauge of a corporation's profitability and how efficiently it generates those profits. New investors are often faced with many terms that they may not know or understand. While this may seem intimidating, it's important to learn common financial phrases and terms when you start investing to help raise your confidence and ensure you're making informed decisions. Furthermore, you have to know what these things mean and make use of fundamental strategies to favor you. It's essential to get your head around useful tactics before you start investing. Tip number 2. Keep your emotions in check. Emotions play an important part in our daily lives and makes us human. However, in terms of investing, it can make or break you. Investment decisions are literally quantitative exercises, but sometimes investors allow their emotions to take control over them and create biases in making their investment decisions. A lot of empirical evidence proves that most bad investments are fairly linked to emotions. Most investors feel ecstatic when they see their stock investments go up. When this happens, they go and tell everyone about how much money they've made, and soon enough, they'll check their stocks weekly or daily even. Because of this, their investments become heavily influenced by emotions, and the ups and downs of the stock market will determine their overall well-being. However, a good investor would do the opposite. The investors that succeed are those who become happy when the stocks go down. This would mean that it's gotten cheaper and they can buy more at an affordable price. In the long terms, they'll get higher returns. This is the concept that Warren Buffett has talked about. You're dealing with a lot of silly people in the marketplace. It's like a great big casino and everyone else is boozing. Basically, you should aim to buy low and sell high. However, some investors do the exact opposite. Tip number 1. Ignore the minutiae. This is an easy thing to do, yet hard to sustain. A lot of investors are too caught up on updates about the stock market, and if you're one of those people, you're probably hooked with the short dopamine hits that you get from reading them. While it's good to be updated, it does take its toll. In simple terms, info overload means that a person inundated with data has a harder time making decisions. Swinging at a fastball is hard enough, being pelted with them makes hitting even one just about impossible. This heavily influences the way that you invest, and this will reflect in your investment returns. But looking too closely on the short-term patterns, you lose sight of the overall picture. It's good to know that you shouldn't sweat the small stuff. Don't feel mystified by or feel the need to follow the short-term gyrations of the financial markets. Ultimately, the prices of stocks, bonds, and other financial instruments are determined by supply and demand, which are influenced by thousands of external issues and millions of investors' expectations and fears. The tips that you've learned today will help you walk through the challenges in investing in the stock market. We wish you the best of luck, and we hope you can reach those high investment returns. Let us know if you have any more tips that beginners should know in the comments below. As usual, do nudge on the like and subscribe button to help us out. Until then, we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!